Until very recently, I was the faculty advisor to the Johnson Investment Council Student Managed Fund at the University of Cincinnati. The student-run fund is a small fund with about $500,000 invested in stocks, bonds, and alternative investment vehicles like real estate investment trusts, or REITs, and master limited partnerships, or MLPs. In some ways, you and my student managers may be very similar. You and they have heard a bunch of stuff from courses and off the web about investing and are not quite sure what to think about it all. That's likely because there are so many conflicting messages. In the case of my university students, the college itself sends mixed messages. In the classroom, most finance professors preach market efficiency, which suggests passively holding a broad index fund. But the flat-screen TV monitor in the lobby runs financial news programming with guests touting active management, saying things like, there are really good buying opportunities out there in the consumer durable sector for those who are willing to get on the train before it leaves the station. You and they may also be intimidated by both the amount of material and the material itself. Much of the material can be fairly mathematical, with a heavy emphasis on statistics. Sometimes it seems like the mathematics is just there to obscure something that is really common sense. Other times, the material doesn't seem to make any kind of sense, common or otherwise. My role as a faculty advisor to the fund is unlike the typical role played by faculty in lecture-style courses. In lecture-style courses, the professor usually tells the students what to think. With the fund, I let the students decide what they should be thinking about, what they should be doing, and how they should be doing it. Ironically, this freedom often paralyzes them, making them reluctant to make a decision at all. They are so used to thinking that there's a correct answer. They don't understand that there are no textbook answers or easy-to-follow recipes for success at investing in the real world. Rather, because markets reflect the aggregate behavior of many investors who collectively have beliefs that are equal parts whim and useful information, it is very hard to know what the market is saying, let alone predict what it might do. Furthermore, many of my student managers are working on the fund basically in their spare time, on top of coursework, exams, papers, internships, part-time jobs, and worries about who they're going to go out with on Thursday night. So that my student managers are not overwhelmed, I needed a framework that would allow them to add value, but also a framework that would be okay if it had some benign neglect. I also felt that each student could gain confidence by being able to become an expert in a particular area, either a type of security, say equity versus fixed income, or a sector, say manufacturing versus consumer discretionary, or an industry, say entertainment versus pharmaceuticals. I think the framework I developed for them will be useful for you too, my other students. While my guess is that most of you are not worried about who you're going to go out with on Thursday night or any other night, my guess is also that most of you have significant demands on your time and also need a framework that is open to varying degrees of activity and will allow you to focus on some specific areas of interest to you. The framework is useful from a pedagogical viewpoint as well. It lets you see exactly where you might be able to add value. It also lets you see how to evaluate whether you're actually adding value. I should note here that while I've been talking about what you can do, all of the material covered in this course also applies if you delegate management of your investments to a professional manager. This framework is useful for seeing where and whether the professional is adding value for you. So let me describe the framework. Although I said there's no simple, easy-to-follow recipe for investing in the real world, you can think of the framework as being similar to one of the mother sauces in French cuisine. There are 6 such sauces: the milk and flour-based bechamel, the light and dark stock-based velouté and espagnole, and the emulsified egg-based hollandaise and mayonnaise, and finally the vinaigrette, based on oil and some sort of acid like vinegar or citrus juice. Each one of these mother sauces has its own basic recipe. The mother sauce for my investing framework is a completely passive portfolio. In French cooking, you add ingredients to the mother sauce to get different variants. For example, if you add tarragon to hollandaise, you get a béarnaise sauce. Cheese to a bechamel yields a sauce mornay, and red wine to an espagnole produces a bordelaise, and so on. With the investment framework, you don't add different securities, rather you add different types of active investment strategies on top of the passive mother portfolio. So to summarize, the investing framework consists of two main steps. Step 1 is to form the mother sauce. Step 2 is to add layers of activity. Later in the course, we'll discuss a critical step 3, which is to evaluate the efficacy of the activity in step 2. Let's discuss each one of these first two steps in turn. In principle, the mother portfolio should be a completely passive portfolio that mirrors the market. What do I mean by a passive portfolio? By passive, I mean a portfolio that doesn't need tending, one that doesn't need you to actively trade. As we will see, there is no perfectly passive portfolio. You'll have to do a certain amount of maintenance that I'll describe in later lectures. But for now, simply think of it as a buy and hold strategy. Next, what do I mean by the market? Well, theoretically speaking, I mean every security in the world. Of course, that's not going to be practical. So let me expand upon what I mean by the market and why such a portfolio might be desirable, at least in theory. After that, we can discuss how you can get close to that ideal in the real world. Theoretically, the market portfolio consists of all of the assets, including stocks and bonds, in the world, in proportion to each asset's contribution to the total value of assets in the world. This last part is really important. In general, a portfolio is defined by two things. 1, the set of securities contained in it, and 2, the fraction of the portfolio's total value contained in each security. If we consider only portfolios that contain every asset in the world, a long list indeed, then the difference between any two portfolios can be characterized solely by how the total portfolio is allocated across the assets. That is, different portfolios have different portfolio weights, where the weight placed on any one asset is the fraction of the total portfolio value invested in that asset. You can think of these weights as the weights in a weighted average. The weights all sum to 1. Those assets that get more weight will have a bigger impact on the average. For example, let's say you have $500,000 in which to build a portfolio. An equally weighted portfolio of the equities in the S&P 500 firms, the 500 largest companies in the United States, will have no weight placed on fixed income securities such as government or corporate bonds, but will have 1/500th of the total value, or in this case $1,000, invested in each of the stocks of the firms on the S&P 500 list. Contrast this with a value-weighted S&P 500 portfolio. A value-weighted S&P 500 portfolio will again just allocate weights to the equities of S&P 500 firms. But now, in contrast to the equally weighted portfolio, the weight placed on 3M Corporation, for example, will be approximately 21 times larger than the weight placed on Abercrombie & Fitch, because the value of the outstanding shares of stock in Abercrombie & Fitch is only $3.85 billion, whereas the market value of 3M is about 21 times bigger at $81 billion. The return on the value-weighted S&P 500 portfolio will be more sensitive to the return on 3M than on Abercrombie & Fitch. And the return on the equally weighted S&P 500 portfolio is equally sensitive to Abercrombie & Fitch as 3M. So back to my original question. What do I mean by the market? I mean a value-weighted portfolio of all the assets in the world. Thus, in addition to including the stocks in the S&P 500, we also need to include the stocks of large non-U.S. firms, the stocks of mid-sized and small companies, both domestic and foreign, the corporate bonds of these firms, the government bonds of every country, The securities included under alternative investments, such as REITs and MLPs, and commodities like gold, oil, wheat, silver, etc. The idea of passive investing is that you give up trying to pick winners, but you still want the return from those winners. So instead of spending effort trying to identify the set of securities that might be winners, you simply hold everything to ensure that you don't miss out on the returns from the winners. Of course, I'm sure you're saying to yourself, but don't I also not miss out on the losers? That's true, but that might be okay on average. If everyone is worried about the losers like you, then the market prices of all those assets will reflect discounts such that on average, you'll be able to make money. Given this discounting, those securities that turn out to be winners will go up by more than without the discounting, and those that turn out to be losers will go down by less. On average, you're good, and you haven't spent much effort. This actually reminds me of something that happened while I was in graduate school. One of my office mates shared a house with somebody who attended the Culinary Institute of America and worked as a line cook at a high-end restaurant downtown. We all liked to cook and eat, and we'd get together periodically to make elaborate meals of things like salmon and duchelles in crotte. It was the 80s after all. The line cook heard about a customer at the restaurant whose husband, a wine lover and collector, had recently passed. Prior to his passing, he had amassed what some thought was a pretty good collection of wine, consisting of thousands of cases, more than anyone could drink in many lifetimes. Many of the cases were unmarked and still in boxes. Since his wife didn't care much about or even know much about wine, she decided to sell it all. And since she didn't want to go through the trouble of opening all the unmarked cases, she decided just to auction them off blind. The debate at one of our dinners was whether this made any sense, whether this was good for her or good for the buyers. And did we want to pool our meager resources and bid on a case? In the end, as a line cook and a couple of PhD students on minuscule stipends, we just couldn't justify it by the expense of a luxury item like wine. But we did conclude that it would be likely a good deal for most buyers and a bad deal for her. Given the uncertainty about the quality of the wine, buyers would likely pay fairly little so that the average return compensated them for the risk. We also concluded that the people that would do best would be those who could buy many cases. Anyone who bought a representative random sample of many cases would likely get some above average cases that would offset the below average cases. If we just bought one unmarked case, there was no chance that half would be good and the other half bad. Rather, it would either be all good or all bad, and that was too risky for us. Since we could afford at most one case, we decided to pass. Okay, so this is very similar to the situation with a passive portfolio. If you buy a portfolio of everything, there will be winners that offset the losers. And since most people can't tell which is which a priori, the average price of the whole is likely to generate a decent return. So this is why to start, I want a portfolio of everything. But why a value-weighted portfolio? Okay, so there's a couple reasons for that. First, what's the alternative? To buy one share of everything? Realize that the number of shares a company issues is fairly arbitrary. They could have issued twice as many shares at half the price. If they had, your one share would represent only half of the exposure to the firm's prospects than if they'd issued half those shares. Furthermore, many firms are comprised of divisions or subsidiaries that could be, and in many cases have been, spun off and traded as separate entities. So one share in a conglomerate represents a different amount of resources than one share in a single division firm. We don't want our passive portfolio to be determined by these somewhat arbitrary things. Rather, we want our passive portfolio, like the wine cases, to be a representative selection. A value-weighted portfolio is just that. It's equivalent to owning a fixed fraction of all the productive resources in the world. If 3M controls stuff worth 21 times the value of the stuff controlled by Abercrombie & Fitch, then your fair share of the world portfolio of productive resources should have 21 times more dollars in 3M than in Abercrombie & Fitch. While you cannot practically form such a market portfolio, mutual fund companies like Fidelity or Vanguard can. That's because they can pool a lot of people's monies together and buy a very large portfolio. In addition, many financial services companies offer index funds that are designed to mirror broad-based indices, which themselves are like portfolios of securities. For example, many firms offer S&P 500 index funds. There are funds for the Russell 2000, which is an index that represents a portfolio of 2,000 small market cap stocks traded in U.S. markets, with approximately half having market capitalization. Now that's the number of shares outstanding times the price per share. The outstanding market capitalization of these firms is less than $500 million. So not very big firms. The MSCI index, which was created originally by the Morgan Stanley Capital International, is a portfolio of about 1,600 equities across the globe. They have a fund that includes the U.S. and also one that includes everything but the U.S. By the way, all you need to do is spend some time looking on the web, and you can find lots of funds. There's lots of information about what's included in the funds and what they're supposed to cover. An index fund is simply supposed to track its index. That is, when the value of the index changes, say, X% on a given day, then the value of the fund is supposed to change exactly X% on that day too. Any difference is referred to as tracking error. While there is some skill in forming a portfolio that has very little tracking error, since the managers of these funds are not actively trying to outperform the index, the fees on index funds should be very low on average. But there is some variation in both the fees and the tracking error. A few minutes on the web and you should be able to find an index fund with the best combination of low fees and tracking error. Information on fees and tracking error is readily available on the web. There are also exchange-traded funds, or ETFs, which are funds formed to mirror the returns on a specific sector, say consumer goods, financials, healthcare, technology, utilities, services. The big difference between an ETF and a passive index mutual fund is that you can trade ETFs during the day like stocks. With a mutual fund, you must redeem shares in the fund at the closing value at the end of the day. For the student-run fund, I did not want them to hold a passive position simply by holding a single broad index like the MSCI All-Country Index. Rather, I wanted them to form a fund of funds where portions of the money could be held in individual ETFs. The students would determine the portions held in each ETF so that the collection of the ETFs represented the market. That is, we determined the fraction of the total amount of money invested in the world that is invested in U.S. manufacturing and invested that fraction in a fund of U.S. manufacturing firms. We did this for as many sectors as possible, trying to cover all the sectors, being careful also to invest in global ETFs or indices in order to gain exposure to the returns of the global capital market. In the end, we had a portfolio of ETFs and index funds that represented a sizable fraction of the world portfolio. The reason we formed a portfolio of ETFs and index funds was because it allowed the students to be both active and passive. If we wanted to just be passive, we would have put all of our money into the broadest possible ETF like the MSCI All-Country World Index Fund or the ACWI. That would have saved on transactions costs. Okay, so what's step number 2 in this process? Once we form the portfolio of funds, I challenge the students to beat it. For this, there are a few things that could be done. We'll discuss in detail throughout the course how to do the analysis to decide what to do exactly. For now, let's just examine the kinds of things that you can do. I'm going to start with the first activity, and this has the highest level of thing that you can do, and then work down to the most detailed thing you can do. So let's start with this highest level thing. The first thing that you can do is to time the market. Timing the market means to get out of the market if you think it's going to do poorly, and get back into the market when you think it's going to do well. When you get out of the market, you'll want to put your money somewhere safe, some low-risk treasury bond, say. Then when you think the market's going to rebound, you get out of the bonds and back into the market. This is like standing on the sidelines when the game gets rough and putting yourself back in when the game turns out in your favor. Of course, this begs a bunch of questions. When you want to stand on the sidelines, which bonds do you buy? Short-term treasuries that mature in a year? A longer-term treasury that matures in, say, 10 to 20 years? What recommends one over the other? We'll discuss these issues and other relevant questions in subsequent lectures. But for now, the point I want to make is simply that you can try to beat the market by plunging in and out of the market. A less extreme approach would be to always hold some riskless and risky securities. For example, start out with 40% in safe treasuries and 60% in a global ETF. Then you can try to do better by upping this 60% in the market when you think the market is going to do well and upping the 40% in treasuries when you think that the market will tank. Let's call this asset allocation. That is, you must decide how to allocate your investment across asset types, with stocks and bonds being the two most common types. Okay, so this sort of timing behavior, that's the type of activity that I'll call type 1 activity. So what's type 2 activity? The second type of activity is holding fixed the amount that you have in the market versus treasuries. The second thing that you want to do is reallocate money across sectors. This is easy to do if you have sector funds or ETFs. You just sell off one of your positions in one of the ETFs and use the proceeds to buy more of another ETF in a different sector. This makes sense if you think that the return in the sector you sell will be lower than the return in the sector you buy into. In a sense, you are timing, not the market, but you're timing across sectors. Okay, so that's the second type of activity. Okay, so what's the third thing that you can do in terms of activity? Holding fixed the amount that you have in risky securities and holding fixed the amount that you have within each sector, the third thing you can do is try to find individual securities within a sector that you think will outperform that sector. Let's call this stock picking or security selection. The idea here is that you can, by studying individual securities, find those that you think are undervalued and will go up a lot. While this stock may be in your ETF already, it will likely represent a very small fraction of the ETF. For some ETFs, for fairly broadly defined sectors, the biggest stock held by the ETF will represent only a couple of percent, with many ETFs holding hundreds of securities. For example, for BlackRock's iShares Global Consumer Discretionary ETF, the largest holding is Toyota at 6%, with McDonald's and Home Depot around 3 to 3.5%. For some sectors, defined by a very few very large firms, a single firm may be 10 to 15% of the ETF. For example, AT&T, Vodafone, and Verizon represent about 40% of the iShares Global Telecom ETF offered by BlackRock. So, if you think that McDonald's is undervalued, you can exploit this by selling off some of the consumer discretionary ETF and using the proceeds to buy McDonald's stock. In this way, you will still have exposure to the benefits and the risks in the consumer discretionary sector, but you will have a portfolio that overweights McDonald's relative to the market weight of McDonald's in that sector. If McDonald's does better than the sector as a whole, then your overweighting, your adjusted consumer discretionary sector portfolio will have a bigger return given the outperformance of McDonald's. Okay, what's the fourth type of activity you can undertake? So far, we have only discussed strategies in which you figure out how much each security to hold. When you want to change your portfolio weights, you sell something and use the proceeds to buy other things. The three types of activities discussed above were different only regarding the set of things that you would sell and the set of things that you would buy. There is, however, another logical possibility for active management that you can do, but I and the University Investment Committee will not let my student managers do. That's any strategy that requires shorting or taking a short position. Okay, so first, let me explain what a short position is. Then I'll explain the two types of things that you can do that require such positions. A short position is when you sell something that you don't own. How do you do that? Well, you have to borrow the item first, and then you sell it. At some point in the future, the person that you borrowed it from will want it back. Perhaps they want to sell it. Since you sold it, you don't have it to give back. So you have to go back into the market to buy it back. We'll discuss the mechanics of this in a later lecture. For now, simply think of it as selling something that you've borrowed and returning it later. Since each stock certificate for a firm is the same as any other, you don't need to return exactly that same stock certificate that you borrowed. Instead, you can buy back any of the stock in the open market to return it. But the gain that you get depends upon the price you sold it for versus the price you had to buy it back for. So a short sell allows you to profit from a price decline. For example, say you think that a particular firm's stock will fall from its current value of $100 to $90. If you owned that stock, you could just sell it before it fell and use the proceeds to buy something that you think will rise in value. But if you don't own it, you could borrow it, sell it for $100, and wait for it to drop to $90. Then buy it back and return it to the person you borrowed it from. You will get $10 per share. So you can use short sales to speculate on price drops. So that's one of the things that you can do. The reason the student managers are not allowed to do this is because you can lose a lot, more than you have. If after you borrow the share, the price climbs to $130, then you will have to return the shares by paying $130 per share for something that you just sold for $100, for a $30 loss per share. If you buy and hold shares, the most you can lose is the amount that you initially invested. When you short, you're not really investing, you're borrowing. And when the price climbs, the amount that you have to pay, the amount that you owe, climbs as well. Okay, besides outright speculation, the other active management strategy you can undertake is something called arbitrage. With arbitrage, you find two securities that have the same risk, and as a result, should have the same value, but are priced differently in the market. We will see how to identify such situations in subsequent lectures. An arbitrage opportunity exploits the fact that relative to one another, one security is overpriced and the other security is underpriced. To exploit this, you should short the expensive security and use the proceeds to buy the cheap security. An investor makes a profit when the market recognizes their actual values and the market prices come together. That is, you make money twice. First, when the shorted overvalued security's price falls, and then second, when the price of the undervalued security rises. We will see many examples of this throughout the course. In this lecture, we have seen how you can layer various types of active management strategies on top of a passive portfolio. I like this way of thinking about an investment portfolio for a couple of reasons. First, I think it makes clear what you need to do to justify moving away from a passive market portfolio. In the student-run fund, this is exactly the point I tried to make. In order for the student-run fund to do any of the three things discussed above, the students have to make clear arguments as to either 1, why they think risky securities will underperform risk-free securities, 2, why one sector or industry will do better than some other sector or industry, or 3, why an individual stock that they want to buy will do better than the sector or industry that that stock resides in. I think this is a good standard to set for yourself too. Since you have the ability to short, you also can try to exploit relative mispricing by using arbitrage. For that, you need to convince yourself that you know that two things are the same but priced differently. The remainder of the course is all about methods for quantifying risks and values so that you can convince yourself when an opportunity actually exists. Equally important is to be able to convince yourself when an opportunity does not exist. Finally, there is something that I have always said to my daughters that I think is relevant for investing. They would come home from school after an exam, and I would ask them how they did. Initially, they would say, I don't know. And I would say, then you must not have done very well, because part of knowing is knowing when you know and knowing when you don't know. With respect to investing, if you don't know that you know there's an opportunity, then you better not act on that, because it's essentially just a hunch. My goal with the remaining lectures is to get you to know how to measure and how to recognize real opportunities when they do exist.